Welcome back, everyone, to the deep dive. Today we are looking at how we evaluate financial performance. And I was really fascinated by this article from Eighth Wonder Capital, written by Mr. Smith. It's been making the rounds. It really has you thinking differently, especially when it comes to SaaS companies and this whole idea of churn.
Yeah, and it's interesting because a lot of us are familiar with some of the traditional metrics, like return on invested capital or ROIC.
Right,
And
ROIC.
everyone knows that's all about how a company uses its money, how efficiently to turn that into profit. But when it comes to software as a service, SaaS businesses, that might not be the best way to size them up. What do you think?
Yeah, I think that's a really good point. And the article really digs into that, this idea that ROIC and some of these other traditional metrics don't fully account for the long-term value of a SaaS subscriber. Because we're not just talking about a transaction, we're talking about building like a relationship with these subscribers.
Absolutely.
And what's really fascinating about SaaS is that it's a big upfront investment for a lot of these companies to acquire a customer.
Yes.
But then if that customer sticks around, they could generate revenue for years to come. So it's not just that one-time, purchase.
Right, and that's where this idea of churn really becomes central. It's a key factor when evaluating SaaS performance.
Yes.
And it's like, you've got a bucket and it's got a leak in it, so it's constantly draining those potential profits.
That's a great analogy.
Yeah, I thought so. It really helps illustrate the concept.
And the article uses this really interesting example. Imagine a SaaS company has a churn rate of 10%. What does that actually tell us about the subscribers?
Well, I mean, if you break it down, a 10% churn rate means that the average subscriber is sticking around for 10 years.
Wow, 10 years.
Yeah, so you can see how important acquiring and retaining customers is in SaaS.
That's incredible. It really puts the emphasis on those front costs to attract those customers. Because if you can keep them happy and subscribed, those costs can really pay off big time.
Definitely.
This is really flipping the script on how we traditionally think about profitability. But it also made me think about something. How do you account for those upfront customer acquisition costs when a subscriber could potentially stay with a service for such a long time?
Right. Well, I think that's where amortization comes in. Amortization.
Okay, I think I've heard the word.
Yeah, yeah. Spreading the cost of an asset over its useful life. Like if you buy a car, you're probably going to pay it off over a few years. That's amortization.
So you're spreading out the cost over time.
Exactly. So
Yeah.
the article has this really clever idea. They suggest linking the amortization of sales and marketing costs because really those are your customer acquisition costs to the average subscriber lifetime.
Okay, so instead of looking at those sales and marketing costs as just like a single-year expense, you're spreading it out over the potential lifetime of the customer. That's fascinating.
Exactly. So let's say a company spends like $1,000 to acquire a new customer, and they know that on average, a customer sticks around for 5 years. Instead of hitting their books with that whole $1,000 expense right away, they would spread it out over those 5 years.
So you'd only expense $200 a year for that customer.
Right.
That would definitely change the way a company might look in terms of profitability, especially in the beginning.
It really does, yeah.
So this is almost like saying customer acquisition is an investment, not just an expense. Like planting a seed. With the right care, it can grow into a massive tree.
I like that. I like that a lot. And, this kind of reminded me of something from the investment world, this whole idea of 100 baggers.
Oh, I'm a bit of an investing nerd myself.
Yeah.
Absolutely, yeah. I've read Chris Mayer's book, 100 Gaggers. It's fascinating, those investments that return 100 times their initial value. Like, the holy grail.
It really is. And a classic example of that is, Amazon.
Amazon, absolutely.
And Mayer, in his book, argues that companies like Amazon, they might not show huge profits right away because they're plowing so much money back into things like R&D.
Research and development.
But then over time, those investments, they can lead to this incredible growth and huge returns.
Let's see where you're going with this. So the article is drawing a parallel between investing in R&D and investing in customer acquisition in the SaaS world.
Right. And both can be expensive up front.
For sure.
But if you look at it long term, you might see these investments as the foundation for, just massive growth later on.
So you have to kind of shift your perspective. It's not just about looking at profits right now, but understanding the potential of the subscriber base and the value they can create in the long run.
Exactly.
It's interesting, right? We're talking about looking at these SaaS companies through a completely different lens.
It really is a different way of thinking about it.
One that takes into account the long-term value of their subscribers and those factors like churn, You know, it's almost like we have to challenge the way we've traditionally evaluated businesses.
Yeah, yeah. I think this approach really makes us recognize, just how unique the SaaS model is.
It's unique.
It's not just a one-time transaction, it's this ongoing relationship, and keeping those customers happy and engaged is absolutely key. I mean, it makes you wonder if we've been like misjudging some companies
Oh, for sure.
by relying so heavily on those traditional metrics. Are we missing out on some real gems? Companies that have huge growth potential just because they don't fit neatly into the old way of thinking?
It's a really good point. It's like we're trying to use, I don't know, like a ruler to measure the depths of the ocean.
That's a great analogy. I like that.
It just doesn't quite work, right?
It doesn't, and that's why I think understanding churn is so important.
Churn, yeah.
A high churn rate, I mean, that can be a big red flag. It might suggest that the company is struggling to hold on to its customers, which could be due to a lot of things. Maybe they haven't found the right product market fit. Maybe their customer support isn't great, or they could just be facing some really fierce competition.
It's like you said before, that leaky bucket. You can keep pouring in new customers, but if they're flowing out the other side, you're never going to fill it up.
That's right. And that leak, that churn rate, that's what can really make or break a company in the long run. So yeah, investors need to be paying attention to that.
So, okay, let's say we have a SaaS company and they spend like $1,000 to acquire a new customer. And their data, it shows that the average customer lifetime is 10 years. So how would we adjust our view of their financials if we're using this idea of linking amortization to churn?
Well, instead of expensing that whole $1,000 all in year one, we'd spread it out over those 10 years. So essentially, you're only expensing $100 each year for that customer.
So it's like, even though they spent a good chunk of change to get that customer, the impact on their profitability is sort of smoothed out over a decade.
That's right.
So it really changes the whole picture, doesn't it?
Yeah, it does, especially when you're thinking about those early years when a company's really putting a lot of resources into acquiring new customers.
It's not just about short-term gains anymore. It's about sustainable and long-term growth. It's a whole different mindset.
It is. And, in a way, it's similar to how we think about R&D. Like, a pharmaceutical company, they might spend millions and millions of dollars developing a new drug,
Sure, yeah,
and they do that with the expectation that it'll eventually pay off.
right, down the road.
And a SaaS company, they might invest heavily in acquiring customers, knowing that those customers will stay with them and bring in revenue for years to come.
I see what you mean. It's about recognizing the potential, not just looking at the immediate profit.
Exactly. It's about the trajectory, their ability to keep those customers coming back and the potential of that whole customer base.
I'm starting to see how powerful this shift in perspective can be. But what about the challenges? Like, how do you predict churn accurately? Especially for younger companies, ones that haven't been around for that long and don't have years and years of data to go on.
Yeah, that's a really good point. Predicting churn can be a bit tricky, especially when you think about how quickly markets can change and how customer preferences are always evolving.
Yeah.
There are different methods and models you can use, but at the end of the day, it's still an estimate, an educated guess based on whatever data you have and what you see happening in the industry.
So there's always going to be some uncertainty.
There is. That's where having experience and really understanding the specific market comes in. Investors need to kind of assess how believable those churn projections are.
Makes sense.
And they need to consider things like the competition out there, how technology is changing, even the overall economy. All of those things can play a role in how customers behave.
So it's not just a simple formula. You really have to understand the business and the market.
Right, and that's what makes investing both challenging and exciting, I think. It's not just about plugging numbers into a spreadsheet. It's about figuring out the story behind those numbers and making smart decisions based on a big picture view of the business.
So we have to look beyond the numbers, understand the strategy, what makes the company unique, and how well they can build those lasting relationships with their customers.
Exactly, and that's something those traditional metrics often miss.
I'm curious, though, this whole discussion about churn and amortization, it makes me wonder, how relevant do you think this is for businesses outside of SaaS? Ones that still rely on recurring revenue or subscriptions.
That's a great question. We've been focusing on SaaS, but think about all the other industries out there, like streaming services.
Streaming services, yeah.
Gym memberships, subscription boxes, even online education platforms.
They all have that subscription element, right? That ongoing relationship with the customer. So churn's going to be a factor for them too.
Absolutely. So even though the actual calculations might be different, the big idea is the same. Churn matters.
Churn matters, yeah.
It affects profitability. And businesses, no matter what industry they're in, they need to be actively managing it.
It's amazing how these ideas can be applied across so many different industries.
It is.
It shows how important it is to stay curious and be able to adapt. especially as investors and business owners.
I agree. The world's always changing, so we got to keep up, right? We got to change how we think to stay ahead of the game.
Okay. So as we dig a little deeper into this whole idea of, evaluating businesses in this age of subscriptions, I think we need to add another layer of complexity to this.
Okay.
Price increases.
Oh, yes.
How do you raise prices without sending all your customers running for the hills?
It is a balancing act, for sure.
The article touched on this a little bit, but I really want to unpack this further. So how do you factor those price increases into this model where we're connecting amortization and churn?
It's a great question, and it definitely adds another layer of complexity. Because on the one hand, price increases, those can boost your revenue and your profitability, but if you're not careful, you could end up increasing churn. Customers get unhappy, they don't see the value anymore. It's like walking a tightrope, right? You got to find that sweet spot where you're maximizing revenue without losing your customer base.
Exactly.
And this is where really understanding your customers in the market becomes so important. Things like brand loyalty, how much value customers perceive, what your competitors are doing with their pricing, even just the overall economy. All those things can affect how people react to a price hike.
This sounds incredibly complicated. Like, how do investors and business owners even start to make sense of this? Are there tools out there, frameworks, anything that can help navigate all this complexity?
There are, and it's really fascinating stuff, and that's what we're going to explore more in the final part of our deep dive, so stay tuned.
We've been on quite a ride today, haven't we? Really diving deep into this whole world of SaaS businesses.
Challenging some of those old assumptions about how we measure success.
And, just when we thought we were starting to get a handle on things,
You threw that curveball.
yeah, the whole impact of price increases.
Right, because it's not just about acquiring customers and keeping churn low. You also have to think about how to grow your revenue.
Exactly. And that often means raising prices at some point.
But you got to be careful.
For sure. If you get too greedy and jack up prices too much, you risk scaring off your loyal customer base and increasing churn.
On the other hand, if you're too hesitant to raise prices, you might be leaving money on the table and limiting your growth.
It really is a tough balancing act.
It is, and there's no magic formula. The right approach depends on so many things, like your brand, your competition, how much value customers perceive in your product, even the overall economy.
So much to consider. It feels like you need a PhD in economics and psychology just to figure out the right pricing strategy.
Well, maybe not a PhD, but you definitely need a solid understanding of your target market and what they're willing to pay.
Makes sense. But how do you even begin to figure that out? Are there any frameworks or tools we can use to make this whole pricing thing less of a guessing game?
There are some really interesting approaches out there. One that I find particularly helpful is the concept of value-based pricing.
I've heard that term thrown around, but I'd love to hear more about it.
Sure. So with value-based pricing, you shift your focus. It's not just about covering your costs and adding a markup.
The old cost-plus method.
Exactly. Instead, you base your price on the value your product delivers to the customer.
So it's like saying, hey, our product can save you $500 a year, so that's what it's worth, instead of saying it costs us $50 to make this, so we'll sell it for $75.
That's the idea. And this approach really aligns well with the whole recurring revenue model of SaaS.
I see what you mean. If you can clearly show customers how much value your product brings and tie your pricing to that value, you're in a much stronger position to justify price increases down the road.
Exactly, because you're not just arbitrarily raising prices, you're showing them that the increased price reflects the increased value they're getting.
Makes sense. But how do you quantify that value? I mean, it seems kind of subjective, doesn't it?
It can be, but there are ways to make it more concrete. You need to really understand your customers, their needs, their pain points, and how your product helps them overcome those challenges.
So you need to gather data, talk to customers, really dig into the numbers, and understand the real impact your product has on their business.
That's right. It's almost like you become a consultant for your own customers.
You have to understand their business inside and out.
Pretty much. The better you understand your customers and the value they're getting, the more confident you'll be in setting your prices. And when you do need to raise prices, you can explain it clearly and frame it in terms of the extra value you're providing.
So it's not just about adding a random percentage increase. It's about having a solid reason backed by data.
Exactly. And this brings us back to churn. If you're constantly delivering value and exceeding expectations, customers are less likely to jump ship when you do have to adjust prices.
It's all about building those strong relationships and earning that trust.
Absolutely. It's a long game. You're not just trying to make a quick buck. You're building partnerships.
Well, this has been a fascinating discussion today. We've really gone down the rabbit hole with SaaS, explored the limitations of those traditional metrics, and discovered some really interesting new ways of looking at these businesses.
It's definitely challenged us to think differently and to keep an open mind.
So as we wrap things up, what are some of the key takeaways for our listeners? What should they be thinking about as they evaluate SaaS companies or even their own subscription-based businesses?
I think the biggest takeaway is this. The old rules don't always apply. We can't just focus on short-term profits. We have to understand the bigger picture of how value is created in the SaaS world.
It's about seeing the whole story, the strategy, the long-term potential.
And remember, churn is king. Keep a close eye on it, nurture those customer relationships, and always aim to over-deliver on value.
And when it's time to raise prices, do it strategically. Back it up with data and make sure you're delivering even more value to justify the increase.
Those are the principles that separate the winners from the losers in the SaaS game.
Well, we hope this deep dive has given everyone a fresh perspective on this exciting world of SaaS and the power of recurring revenue.
Remember, in business as in life, it's about the journey and the destination.
Until next time, keep diving deep.